Welcome, everybody. Happy New Year. Today, what I wanted to talk about is some tax planning advice. As now that we're approaching the new year, starting off fresh, and everybody gets their New Year's resolutions together, this is a perfect time to start planning out your year to save yourself some money on taxes. Some of the things that we're going to discuss today is items that you normally would do on a normal everyday basis, but just kind of have a little bit of tweaks. So the first item that I'd like to discuss is dependent care. Dependent care, there's two options. There's an option to take a deduction on your tax return at the end of the year after you've already paid with your post tax dollars, or, which is what I would recommend, is you could take a pre tax deduction. So, what happened is your employer would have to offer it. It's known as a flexible spending account. And what you're able to do is you're able to contribute up to $5,000 for married filing joint filers. And you're able to have that withheld from each of your paychecks. If you wanted to do it equally over the year, if you wanted to get it done in one shot, you're more than welcome to do it any which way you can. But that money comes out of your account, out of your paycheck pre-tax. So basically what that does is that reduces your tax liability. It also can put you in a lower tax bracket. Granted, it's not a lot of money, but still, $5,000 of something that you have to pay out anyways. It's just a little bit of help that can help you save taxes as well as save on your tax bracket. Now, the $5,000, it is total, so meaning husband and wife cannot each contribute $5,000. It is total for the couple. On this one, you do have to take, so this is a use it or lose it. So you do have to take the funds out. At the end of the year, there is a 3-month grace period. So you have until March 31st to go on ahead and take those funds out from the prior year. So what you would do here is you would need to submit your child care bill or a written statement to the administrator of the plan, and they would go on ahead and wire the money or EFT the money back into your bank account. And then you can utilize that money for child care expenses. The way I like to do it with my family is I like to save it all up for throughout the year, and then come January or February, I'll submit my daycare bill for the entire year, and then get that entire amount back. And it helps. It helps, helps from a saving standpoint as well. So that is definitely an option and something that I would by all means suggest to do. The next item I would like to discuss is a health savings account. Health savings accounts are accounts that are offered if you are enrolled in a high deductible healthcare plan. A lot of employers nowadays do matches to health savings accounts. You might not have to contribute any money, or you might have to contribute and they'll match up to a certain amount. So depending upon your employer and depending upon the plan, if you are enrolled in a high deductible high deductible healthcare, I would strongly suggest also making sure that you are enrolled in a health savings account. Similar to the dependent care benefits, this one is not a use it or lose it, so it does roll over from year to year. There are annual contribution limits to that account. And again, I don't typically suggest overfunding this account. So my suggestion is at the bare minimum, if your employer has a match, the bare minimum that I would contribute is just contribute enough in order to get that match from your employer. Now, if you know that you're going to have a good amount of unreimbursed medical expenses, then I would contribute more to that account. You should also keep in mind that there are other stuff beyond just the co-pays, co-pays, prescription drugs and whatnot. There are items that are beyond that you can utilize this account for. You are able to use this account for dental. That's unreimbursed. Again, everything has to be unreimbursed. You're not allowed to, get insurance reimbursement and then go on ahead and say, okay, I need to get reimbursed for my HSA account. It doesn't work that way. So these have to be unreimbursed expenses. So you can get glasses. If you don't have eye care, you can pay for an eye care doctor visit. Your glasses, your frames. You can get hearing aids. You can get over-the-counter medicine. You can get Band-Aids. There's a whole entire list, and I'll post the list of just general items. There are some things that are excluded, like you can't use it for a gym unless you have a doctor that writes you a script and say you medically need to use it for a gym. There's also a couple of handful of items that it's not useful for. But again, this reduces your tax. This reduces the amount of earnings that you get. So if you look at the way I look at it, I have to pay my medical expenses either which way. I might as well pay that with pre-tax dollars versus post-tax dollars. I might as well reduce my tax liability at the end of the year and my taxable income at the end of the year. If you don't utilize an HSA account, it is very difficult to get a deduction for health expenses. So the way the deduction for health expenses works at the end of the year is your health expenses need to exceed 7.5% of your unadjusted gross income. Now that's 7.5% of unreimbursed expenses again, and you have to itemize your deductions. So I always recommend to everybody, if you have a health savings account, maximize the account, try to project out what you're going to spend in the next year in benefits, or take an average from the past few years, and just make sure you have enough contributed into the account. The limitations vary depending upon if you're single, plus one, or you have a family plan. So again, I would always just look at to see what the contribution limits are, and I'll post those contribution limits as well. And just be sure that, if you want to, you can max it out. But if you don't, then you don't have to either. Keep in mind that this plan rolls over from year to year. So if you still have $2,000 at the end of this year, that money doesn't go away like the dependent care benefits. That money stays. So that money is always going to stay in your account until you're ready to spend it. They do provide you with a debit card, so you can utilize that card at like a CVS or a Walgreens. But again, I don't suggest buying groceries or things that are not on the approved list of items to purchase.
The next item that I did want to cover is 401k. 401k is a good tax planning tool, not only for your future, but also for tax planning purposes to reduce your tax liability for the year. Most employers offer a 401k, which also incorporates a match. Typically, for that match contribution, you need to also contribute money to that 401k. So what that means is if you got to just check with your employer, check with HR, and see what that amount is. Typically, it's about a 5%. So a lot of times they'll do dollar for dollar, so 5% in. The employer will also match 5%. But again, you also have to make that contribution yourself. There are two different types of contributions. You could do what's known as a Roth contribution, as well as a traditional contribution. The Roth contribution is post-tax, which means that you pay the taxes on it today at your tax rate that it is today. The pre-tax contribution means that you receive a deduction for the amount that you contributed to your 401k. So what that means is if you make $100,000 of income and you contributed 5%, you would pay taxes on $95,000 of income. Now that is only for state and federal taxes. FICA and Medicare, you still do have to pay that tax in on the amount. The Roth contribution, what that means is if you contribute, again, same example, you make $100,000 for the year, you contribute $5,000 in there, you will still pay tax on your $100,000. So Roth has a couple of advantages. One of the advantages, required minimum distribution. Right now, the tax law as it stands today is when you reach the age of 73, there are tax tables and actuary calculations that based on the account balance as well as based on your age, that you will be required to take out a minimum amount out of your retirement account. If you do not take that minimum amount out, there are steep penalties that are going to be forthcoming. So if you have Roth accounts, that minimum amount does not apply because you've already paid the tax on it. So the IRS does not care whether or not you pull the money out or whether or not the money stays within your account. The other pro on that one is as if you're younger and as you're progressed throughout your career, typically your earnings are less. So typically when you first start out your career, maybe to about midway through your career, it depends upon what you do. Some people later in their career, once you max out your earning potentials, you really want to take that money away from the Roth. So my suggestion is early on in your career, you want to more heavily invest in a Roth IRA. So you'd invest more in a Roth early on in your career because theoretically, early on in your career, your taxes is going to be less. You're going to be in a lower tax bracket. You're not going to earn as much money. But when you get further in your career, you're going to earn more money. And you're going to be basically at your max earning potential right up to retirement. And you don't want to be paying that max amount on your Roth contributions. I'd rather see you get a tax deduction instead of paying that max amount. Because on paper, what will end up happening is you will actually typically end up earning less money when you retire versus than when you're actually working. So what that means is that once you retire and you stop working, your tax bracket will probably go down and resulting in a lower tax. But again, it's all speculation because things can change. Depending upon your scenario, your situation, everything can change. But generally, good rule of thumb is early in your career, contribute to a Roth. As you start getting to like your max earning potential, I would start scaling back from a Roth and start putting into a traditional. Now, the other benefit to a Roth is that you are able to pull money out of a Roth account. 401k, Roth IRA in general, you are able to pull money out. You can pull up the money that you put in as long as it's sat in that account for 5 years. You can pull it out tax free. There is not a penalty on it. However, if you pull out any of the earnings on the account, there is a penalty on that portion of that money. So again, just kind of take that into consideration if there's ever a point in time. That's just something to consider. Whereas a traditional, there's a 10% penalty, unless there's a first-time home buyer is pretty much one of the most common ones where you can eliminate that first-time home buyer, that 10% penalty for a first-time home buyer. Speaking on traditional IRA or traditional 401k, whichever way you want to call it, pretty similar. Like I said, IRA is separated from your employer, whereas a 401k is with your employer. So on a traditional 401k, when you contribute money in, that money is taken out off of your taxes. So meaning income is reduced by whatever you put in. Contribution limits are $23,500. If you are over the age of 50, you can contribute an additional $7,500 catch up, which basically brings that total up to $30,000. Again, that is something that you can do. So of course, as you get older and those expenses come down, you start having a little bit more money to spend. It does make a little bit more sense to try to get to as close to that max as possible. There is no special, specific rate that you should contribute. Again, I always suggest contributing at a rate that maximizes your employer contributions. Some employers also have a profit share that goes in as well, which is separate. So if you have a match, then definitely contribute the max to receive in order to receive that matching contribution. You don't want to leave any of that on the table because that's important to have. I do also want to speak on the traditional 401k because sometimes people get confused and they're like, I don't really have an extra 5% of my pay sitting around. Well, because that amount of money is not subject to state and federal income taxes, it's still subject to FICA, which is Social Security and Medicare. The actual percentage that you're contributing is not actually going to be a 5% pay cut. So if you say, hey, I'm going to contribute 5%, you're not actually going to see 5% less in your take-home pay. You might see 4% less, 3.5% less. Again, just depending upon rates and whatnot, it's not going to be that dollar for dollar less amount, but you will be contributing it for a later date. Basically what happens is you won't have as much withholdings on it. So because you don't have as much withholdings, your take-home pay would be greater. And, therefore you're not going to recognize that full percentage. So again, thinking of the 5%, it's really not that much of a hit. But I would definitely suggest bare minimum 5 to 10%. 10% is probably more of a realistic number. You should probably try to get up to 10% if you can, and then obviously higher if you can as well. The more the better, because you can retire at an earlier age and just reduce your taxes now. I mean, I think everybody likes to have more money now versus pay it over to the IRS. The other things to consider, again, is, it's just when do you want to retire? I mean, if you want to retire at an early age, then you're going to have to put in more money into that account as well. The other thing is rollovers. If you change jobs, you can roll it over. You can roll it over into an IRA. That is a tax-free amount. Just be cautious with, direct rollers are the best or I should say the easiest, because basically the investment place, whether that be at Empower, which seems to have majority of those retirement accounts right now, will just take that money and just transfer it over. You'll get a 1099, but it'll show a direct rollover. If you get a check, it's a little bit more complicated. It just takes a couple more steps. So when all possible, I always suggest try to do the direct rollover method. Typically they're always offered. You can always keep it in the account. Some employers have specifications where you can't, if you have below a certain balance, they won't let you keep it in there. So just be on the lookout for that, because they will sometimes just send you a check back, and then you will be subject to that 10% penalty unless you roll it within 60 days. Anything else as far as specifics on the retirement, happy to go over, leave it in the comments. But, again, I think the 3 top items, these are items that you're going to need. And it's not that you're doing anything extra, additional. You're just doing on what you would do on a normal basis. If you have children, definitely contribute to the flexible spending dependent care account if your employer offers it. So now I just want to also clarify on that just a little bit. I know I didn't touch on it too much earlier in the video, but just to clarify on that just a little bit. Child has to be under the age of 13. It has to be for care for that child. So, it can't be, technically, it can't be school. So it's usually like pre-K. It's like after school programs can't count for the summertime. But again, if they're in school, it's not going to be a school tuition. Won't count for that flexible spending. As far as the HSA, again, similar, contribute to that. Those are just items that you're normally going to pay for. And then the 401k is just planning. You're going to use that money down the road when you retire. We don't know whether Social Security is going to be around now or it's not going to be around later. So again, it's just good tax planning and get you a few extra bucks in your pocket throughout the year, and just helps out. I feel like every little bit helps that you can reduce your taxable income.